CBDC 101. Understanding central bank digital currencies and their impact on the global economy. Central bank digital currencies, or CBDCs, are a new form of digital money issued by central banks. Unlike cryptocurrencies like Bitcoin, which are decentralized, CBDCs are centralized and regulated by the authorities. Think of CBDCs as a digital version of traditional cash, but with added benefits like faster transactions and lower costs. As digital payments become increasingly popular, central banks around the world are exploring the potential of CBDCs to modernize their payment systems. By adopting CBDCs, countries can enhance financial inclusion, enabling more people to access banking services and participate in the digital economy. While CBDCs offer several advantages, there are concerns about the impact on the global economy. For instance, CBDCs could change the way money flows across borders, affecting exchange rates and capital controls. Additionally, the widespread adoption of CBDCs could have implications on the stability of traditional banking systems. Nevertheless, CBDCs represent an exciting development in the world of finance, with the potential to reshape our economy in the digital age. The role of CBDCs in modernizing national payment systems. Central banks are looking into CBDCs as a way to modernize their national payment systems. By issuing digital currencies, central banks aim to improve the efficiency of transactions, reduce the costs associated with cash handling, and promote financial inclusion. CBDCs offer several benefits for payment systems. For instance, they can facilitate instant, secure transactions, allowing people to transfer funds quickly and easily. This can be especially beneficial for cross-border transactions, which can be slow and expensive with traditional payment methods. Furthermore, CBDCs can help promote financial inclusion by enabling people without access to traditional banking services to participate in the digital economy. This can be particularly impactful in developing countries, where a large portion of the population remains unbanked. However, implementing CBDCs is not without challenges. Central banks must navigate issues such as privacy, security, and the potential impact on the stability of the financial system. Despite these challenges, CBDCs offer a promising opportunity for central banks to modernize their payment systems and better serve their citizens. CBDCs and monetary policy, implications and challenges for central banks. The introduction of CBDCs could have significant implications for monetary policy. With digital currencies, central banks can more effectively manage the money supply and influence interest rates, which can help them achieve their policy goals. One potential benefit of CBDCs is the ability to implement negative interest rates more easily. By charging a negative interest rate on digital currency holdings, central banks could encourage spending and investment, helping to stimulate economic growth. However, CBDCs also present challenges for monetary policy. For example, the widespread adoption of CBDCs could lead to a decline in bank deposits, as people might prefer to hold digital currency directly with the central bank. This could weaken the traditional banking system and affect the transmission of monetary policy. To successfully navigate these challenges, central banks must carefully consider the design and implementation of CBDCs, ensuring they strike the right balance between fostering innovation and maintaining stability in the financial system. Privacy and security concerns in CBDC implementation. Privacy and security are key considerations for central banks when developing CBDCs. While digital currencies offer many benefits, they also raise concerns about user privacy and the potential for misuse. To address privacy concerns, central banks must find a balance between maintaining user privacy and ensuring compliance with regulations aimed at preventing money laundering and terrorist financing. One possible solution is to implement privacy-enhancing technologies that allow for transactions to be monitored for illicit activity while preserving user anonymity. Security is another crucial aspect of CBDC implementation. Central banks must ensure that their digital currency systems are protected against cyberattacks, fraud, and other security threats. This involves investing in robust security measures, such as encryption, secure storage, and multi-factor authentication, to safeguard the integrity of the digital currency and prevent unauthorized access. By addressing privacy and security concerns effectively, central banks can build trust in their CBDCs and ensure their successful adoption by the public. CBDCs around the world. Comparing and contrasting different approaches. Countries around the world are adopting various approaches to CBDC development. Some central banks, like China's, are already piloting their digital currencies, while others, like the United States, are still in the research and planning stages. China's digital currency electronic payment (DCEP) system, for example, focuses on domestic retail payments and aims to replace a portion of physical cash in circulation. Sweden's e-krona project, on the other hand, explores a digital complement to cash, ensuring access to central bank money as physical cash usage declines. Each country's approach to CBDCs depends on their unique economic, technological, and social circumstances. By comparing these different approaches, we can learn valuable lessons about the design, implementation, and potential impact of CBDCs on the global financial landscape. The future of CBDCs, potential use cases and innovations in digital finance. As CBDCs continue to evolve, we can expect to see new use cases and innovations in digital finance. These developments could transform the way we conduct transactions, invest, and interact with the global economy. For example, CBDCs could facilitate new types of programmable money, allowing for automatic, conditional payments. This could be particularly useful for smart contracts, which execute transactions automatically when certain conditions are met. CBDCs could also enable more efficient cross-border transactions, as they can be transferred seamlessly between countries without the need for intermediaries. This could reduce the time and cost of international money transfers, making it easier for businesses and individuals to participate in global commerce. Finally, CBDCs might pave the way for new financial products and services, such as digital wallets and apps that leverage the unique features of digital currencies to offer innovative solutions for consumers and businesses. As CBDCs become more widely adopted, their potential to reshape the world of finance grows. By staying informed and engaged with these developments, we can better understand the future of digital currencies and their impact on our lives.